Welcome back, everyone, to the Deep Dive, where we deep dive into all sorts of complex topics. Today, we're taking a crack at something pretty different. The 2022 UPSC Prelims paper. We thought it'd be fun to tackle the first 10 questions together, give you a sense of what it's like to face this beast of an exam.
Yeah, exactly. We're not going to spoon feed all the answers, but we're going to kind of get into the nitty gritty of the ideas behind each question. Give you a taste of the strategic thinking you need for an exam this tough.
Sounds good to me. Let's jump right into it. Question number one, it's all about the rapid financing instrument and the rapid credit facility. Now, I've heard these terms thrown around, especially when, there's some global crisis brewing. But honestly, I could use a little refresher.
Oh, yeah, I hear ya. So picture this, right? A country's suddenly hit by a massive earthquake, or maybe their economy's just tanked. They need a quick cash injection stat to get things somewhat stable.
So it's like the IMF's emergency fund for countries in dire straits.
Exactly. The rapid financing instrument, that's more for those sudden emergencies, natural disasters, that kind of thing. While the rapid credit facility, that's geared towards low-income countries who are, struggling with long-term economic issues. Both of them, though, offer super fast access to funds without all the strings attached that usually come with traditional IMF loans.
Right, right. So the question gave us a few options.
Yeah.
The World Bank, the Asian Development Bank, but of course the correct answer was the IMF, yeah.
Yep, and it's super important to grasp why. See, the IMF, they have this unique role, right? They're like the global lender of last resort. They're all about keeping the whole financial system stable when things get a little crazy. And those rapid financing tools, those are their heavy hitters.
Fascinating. It's like watching a global financial chess game or something. Okay, moving on to question two. This time we're diving into the Indian economy, and we're getting into the concepts of near and rear. Now, I'm not going to lie, these acronyms always throw me for a loop.
They can be a little intimidating, right? So near, that stands for nominal effective exchange rate. And rear, well, that's a rate effective exchange rate. They both measure the value of the Indian rupee, compared to a bunch of other currencies. But rear's got an extra layer.
Okay, so what's that extra layer that rear brings to the table?
Inflation, my friend. So think of it like this. Near, it's how much one rupee can get you in dollars, euros, whatever. But rear is saying, okay, but how much can you actually buy with those dollars or euros in those countries?
So it's not just about the numbers on the exchange rate. It's about what you can actually buy with that money,
Yeah.
right? The real purchasing power.
Exactly. Imagine you're importing stuff from a country where, inflation is through the roof. Even if the rupee weakens against their currency, the stuff you're importing might not cost that much more because their currency's buying power is shrinking.
Right, that makes sense. So the question threw in some statements about how shifts in near and rear can paint different pictures of the Indian economy. To get the right answer, you really need to understand these concepts inside and out.
Absolutely. It's not just about rote memorization. It's about getting how these economic indicators, like flashing warning signs, they point to deeper trends that affect, everything. Trade, investment, how the whole economy's doing.
Speaking of forces that shape the economy, question three throws us a curveball with the RBI's moves when dealing with a falling rupee. And yeah, you guessed it, high inflation. I always find it fascinating how the RBI tackles these situations.
Well, they've got this whole toolbox of monetary policy instruments, right?
Wow.
When inflation's running rampant, one of their go-to moves is to hike up interest rates. This can kind of cool down borrowing and spending, which can help rein in inflation.
But how does that affect the exchange rate?
Okay, so higher interest rates in India, they can be pretty tempting for foreign investors looking for, better returns. And this increased demand for the rupee, well, that can prop up its value against other currencies.
It's a balancing act then, isn't it? Trying to keep inflation in check while making sure the rupee doesn't take a nosedive. The question threw out a bunch of statements about what the RBI might do, and you had to pick the right one. It really brings home how monetary policy is not just some abstract idea. It's something that affects everyone.
For sure. Every decision the RBI makes has ripple effects throughout the economy. Borrowing costs for businesses, returns on your savings, everything's connected. Okay, enough about domestic economic policy for now. Question 4 zooms out to the global stage with the G20 Common Framework. If I remember right, this deals with debt issues those low-income countries face, right?
You're on the money. It's like all the big players in the G20 got together and said, hey, we need a plan to tackle this debt sustainability problem. It's all about finding ways to, restructure debt for these vulnerable countries so they can actually manage it, prevent those, economic meltdowns.
You got it. It's basically a global effort to stop a chain reaction of debt defaults. The idea is that if the G20 nations team up with those big international financial institutions, they can help struggling countries get back on their feet. It's becoming even more crucial now, with the pandemic fallout, climate change, all those global headaches.
It really drives home the point that we're all interconnected in this global village, right?
Yeah.
What happens in one corner of the world, it can send shockwaves everywhere else. Pretty neat how the UPSC exam just throws you into the thick of these global issues. Okay, ready for question 5. This one's about a financial tool that I've always found kind of intriguing. Inflation index bonds, or as the cool kids call them, IIBs.
Ah, yes, IIBs. Definitely interesting, especially with how things are going in the economy these days. They basically give investors a way to, safeguard their savings from inflation eating away at their returns.
I've definitely heard of them. Can you break down how they actually work?
Okay, so with a regular bond, you're lending money to like the government or a company, right? They pay you a fixed interest rate for a set period. With an IIB, the principal amount itself, it gets adjusted for inflation. So if inflation goes up, the face value of your bond goes up too.
So even if the interest rate's on the lower side, you're not going to lose your purchasing power thanks to inflation, right?
Exactly, that's the beauty of it. And the question threw in some statements about the benefits of IIBs for the Indian economy. Makes you think, how these bonds could be a good option for folks planning for retirement or, long-term savings goals. With inflation looming over us, they offer a way to maintain the real value of your investments over time.
It's a perfect example of how these concepts in the UPSC exam, they're not just theoretical, they have real-world implications for everyone's financial decisions. All right, think we've earned a little break. We'll be back soon to dive into the next set of questions in part 2 of our UPSC Deep Dive.
All right, so we're back and ready to tackle those next 5 questions. Question 6, this one throws us right into the middle of the digital economy, all those foreign-owned e-commerce companies that are making waves in India. Man, this is a hot topic.
Yeah, for sure. It seems like there's always something new happening there. Regulations, market dominance, and the impact on smaller businesses. It's like a whole different world. Where do we even start with all this?
Well, the question focused on picking the right statement about these e-commerce firms, and it really boils down to the complexities of this whole sector. You see, one of the statements highlighted how these companies can basically use their platforms to give their own products an edge, compared to products from other sellers.
Oh, you mean like that whole platform neutrality thing? Are these big companies using their power to squash the competition?
Exactly. And it's a tricky thing because there are no easy answers. I mean, on one hand, these platforms create this huge marketplace, right, for sellers big and small, and that can really boost the economy. But then again, if they're tweaking their algorithms and using their clout to give their own products an unfair advantage, that's going to hurt competition and, stifle innovation.
This question really shows how the UPSC exam goes beyond textbook stuff. They're making you think critically about what's happening in the world today and grapple with these tough policy challenges. Okay, time for a change of pace. Question 7 takes us back to the basics of economics, the real sector.
Ah, the real sector. It's the backbone of any economy, right? It's all about producing actual stuff, goods and services, the things we can see and touch. Think farmers harvesting their crops, factories churning out products, construction crews building infrastructure, that kind of thing.
So the question gave us a list of activities and asked which ones fit into this real sector category. Some of them were pretty obvious, like farmers growing food or textile mills making clothes.
Right, those are classic examples of the real sector in action. They're taking raw materials and turning them into something useful, something that adds value to the economy.
But then there were some curveballs thrown in, things like commercial banks lending money or companies selling bonds overseas. I mean, those are economic activities, but not in the same way as making a car, right?
That's the key difference. Lending money, issuing bonds, those fall under the financial sector. It's a crucial part of the system because it keeps the money flowing, but it doesn't directly produce goods or services. This question really tests your understanding of how different pieces of the economy fit together and, how they depend on each other.
It makes you realize that a strong economy needs a solid real sector as its foundation. And then you need a healthy financial sector to support it, kind of like the scaffolding.
Exactly. Okay, moving on to question 8. Now, this one dives into a concept that often sparks some heated debates in international finance. Indirect transfers.
Oh, yeah, I remember this one. It's been in the news a lot lately, especially when they talk about tax loopholes and creative accounting.
You're right on the money. Indirect transfers basically involve structuring transactions in a way that makes it hard to see who really owns or controls the assets. It can get pretty shady. Sometimes it's about dodging taxes. Sometimes it's about skirting regulations. It's a whole world of legal and ethical gray areas.
The question gave a scenario where a foreign company, instead of investing directly in India, decided to buy a company in a different country that just happened to have a bunch of assets in India. Seems like a roundabout way to go about it.
Yeah, it's a classic indirect transfer move. By doing it this way, that foreign company might be able to avoid certain taxes or regulations that would apply if they invested directly. It's a controversial tactic because, well, it can be seen as exploiting loopholes to gain an unfair advantage.
It definitely highlights how important it is to read between the lines in international finance, right? You need to understand not just the economic theory, but the strategic moves companies make and, the potential consequences for policy. Okay, ready for something a little different? Question 9 takes us into the exciting world of business accounting, specifically the difference between capital expenditure and revenue expenditure.
Yes, the glamorous world of accounting. It might sound a bit dry, but this distinction is fundamental to understanding how businesses invest their money and manage their finances for the long haul.
Well, I'm ready to dive in. I know these concepts are key if you want to analyze a company's financial health and see if they're actually growing. Can you remind us of the main difference between these two types of expenses?
Sure, so capital expenditure, or CapEx, as the cool accountants call it, refers to investments in things that are going to benefit the company for many years. We're talking buildings, machinery, major technology upgrades, that sort of thing. These are big investments meant to generate returns for a long time.
So it's like building a foundation for future success, laying the groundwork.
Precisely. Now, revenue expenditure. That covers your day-to-day operating costs, things like salaries, rent, utility bills, and the cost of the stuff they're selling. These expenses are about keeping the business running smoothly right now in the short term.
The question gave us a few different scenarios and asked us to pick out the one that qualified as capital expenditure. One of the options talked about a company using borrowed money to buy new equipment. That one seemed a bit tricky.
Ah, yes, that one adds another layer of complexity because it brings in financing decisions. See, buying new equipment is generally considered CapEx, but the way they paid for it, whether it's with debt, equity, or their own cash, that doesn't actually change the nature of the expense.
So we should focus on how they're using the money, not where it came from.
Exactly. If the money is being used to acquire something that will benefit the company for years to come, it's most likely capital expenditure. This question really reinforces how important it is to understand basic accounting principles and how they play out in real-world business situations.
Makes sense.
Okay,
Ready to wrap up this set of questions?
let's do it.
Awesome. Question 10 takes us back to the world of government finance, specifically how they issue market-related securities. It's like the government is issuing IOUs to investors to raise cash.
You got it. And this question zoomed in on the difference between securities with a fixed interest rate and those with a floating rate. Makes you think, what factors does the government weigh when they're deciding which type to issue?
I vaguely remember this from my econ classes, but I could definitely use a refresher. How do these different types of securities work, and why does it even matter?
Okay, let's say the government needs a big chunk of change to, I don't know, build a new highway. They can issue bonds, which are basically like IOUs to investors. Now, these bonds can come with a fixed interest rate, meaning the interest payment stays the same for the entire life of the bond, or a floating rate, which changes based on what's going on in the market.
So with a fixed rate, you know exactly how much interest you're going to get, but with a floating rate, it's a bit of a gamble.
Yeah, that's a good way to put it. Fixed-rate bonds offer stability and predictability, which can be a safe bet for investors who just want a steady return. Floating-rate bonds, they're riskier, but they could potentially pay out more if interest rates go up.
The question had some statements about these securities and their role in government borrowing. It made me realize that choosing between fixed and floating rates, it's a strategic decision that can impact both the government's borrowing costs and how much investors earn.
Absolutely. The government has to juggle a lot of factors. Prevailing interest rates, market conditions, how much risk they're willing to take, and then investors have to decide what kind of risks and rewards they're comfortable with based on their own financial goals. It's this fascinating back and forth between the government's need for money and investors' willingness to lend it.
Welcome back, everyone, to the deep dive. We're tackling the last part of our journey through the first 10 questions of the 2022 UPSC Prelims paper.
We've covered some pretty complex ground so far, haven't we?
We have, but you know what? It's been a blast. And for anyone out there thinking about taking the UPSC exam, I hope this has given you a taste of what to expect.
Exactly. Remember, this exam, it's not just about memorizing facts and figures. It's about understanding those underlying concepts and, being able to apply that knowledge to real-world scenarios.
Absolutely. So let's pick